Hello, greetings, and welcome to Dividend Blasters. This is our 75th video. I can't believe that we're on 75. Wow, where does the time go? I'm excited about this video. This is something that I really do enjoy, and it's investing in the energy sector. And I don't invest in sectors, I invest in really good companies and ETFs. But the reason why I'm covering this sector is because I do believe and I know that there's a lot of really good, strong companies to invest in the energy sector, uh, especially for dividend investors, dividend growth investors like myself. So I'm going to cover this, and I'm going to cover why this is great for dividend investors. So 6 bullets here. This is what I'm going to cover. I'm going to cover that there is a growing demand for oil and gas, and why that is, and what we think it's going to be, and why it's good for dividend investors. I'm also going to give you an overview of the current industry, of the energy industry. And my focus really is on oil and gas. But the point here is that uh, we're not looking to exclude any players. We're looking to be inclusive because to have an effective energy policy in our country, we need to have all forms of energy. We need to have a portfolio available, and so, as investors, I think that we should follow that. What is the reason for the growing demand? Well, first and foremost, uh, two things. We have a lot of oil and liquid natural gas right under our feet, more than any other country in the world. That's one thing. Secondly, but even more topical and timely, is we have a new president, we have new government administration, we have a sudden shift in the regulatory environment that is going to be much more friendly to the oil and gas industry. We're seeing it happen. President Trump has issued several executive orders, and we have also a Secretary of Energy and a Secretary of Interior that are from the oil and gas industry, and they understand business, and they want to be friendly, and they also want to help the oil and gas companies grow. And really, our economy is primarily a petroleum based economy. So that's why this is so exciting. It's great for investors. Um, Also, the PE evaluations of many oil and gas companies are very favorable. They are cheap. If you look at the historical trends, they're much cheaper than they were 10 years ago. I'm going to talk a little bit about that. And I'm going to close with there's a handful of companies, about a dozen of them, that have great upside potential. We look at the current price, and we also look at what the consensus price targets are set by experts and analysts on Wall Street, and they all have at least a 10% upside, some much higher. I'm going to go through that. I'm going to share that with you. Before I go further, just a little housekeeping, a disclaimer. I'm not your financial advisor. The purpose of this video is for information and education. It reflects my own personal opinions and also my experience as an independent investor for more than 30 years. So please do your own research, consult a financial advisor if you wish prior to making any major financial decisions. All right, let's get into it. So, I did mention that there's an increasing demand for oil and gas. According to the International Energy Agency, global oil demand is expected to grow by 1.1 million barrels per day this year. That's a lot. That's a global demand. And I will tell you that a lot of the companies that we invest in and we're familiar with are US based companies, and they're traded on the New York Stock Exchange. Very accessible. So I'm going to get into that a little bit more. According to our own federal government, the U.S. Energy Information Administration, it is part of the U.S. Department of Energy. Natural gas prices are forecasted to average an increase of about 20% higher than previously expected. That's good for the producers and everybody in that value chain in the oil and gas industry. Um, and I will tell you, and we know this, if you're a dividend investor and you invest in this market sector, is that many of the energy companies always generate positive cash flow, and they return capital to shareholders through dividends. And we love dividends. And we're also seeing buybacks as well. And this really comes right from our friends over at Fidelity. We do like Fidelity. So that's part of the demand. That's really the forecast, and it's coming from um, the federal government, also international agencies, and Wall Street. All right. The energy sector is great for dividend investors. The average dividend yield, the forward yield for integrated oil and gas companies, is about 4.5%. That's the average, and many of them are much higher, and they're growing faster. The average dividend growth rate, the 5-year average, is about 5%, and again, some of them are much more. What I like to look for in a dividend growth investment, I like to see um, an average yield of in the 4 to 5 to 6% range. It doesn't need to be, and I like if it's in this sector, I don't like anything less than 3% usually. I can make an exception if it's a really big company and they're growing that dividend. But I do like a growth rate of in excess of 6 to 7%. Now I'm a little bit, um, flexible depending on the sector or the company, but it's kind of my rule of thumb. I like to see a summation of around 10% between the dividend yield and the growth rate, but I can be a little bit flexible if I see other intangibles. All right. Recent performance. Now, this to me is fascinating. So, if you look at the year to date for the energy sector, and what I'm doing is I am using um, the Spider Sector ETF for the energy sector from State Street Bank, XLE. It has a year to date, which is really just 2 months, January and February, of a total return of about 6.25%. And that is outpacing the entire market of about 2.34%. That's just the last 2 months, January and February. Let's go back and look at the past 12 months. Well, the S&P 500 was killing energy, more than double. So what you see here is, the larger market is correcting itself because it is overvalued. But you're also seeing an influx, I believe, of investment dollars into this energy sector, particularly the integrated oil and gas companies. All right. So I talked about a little bit about the changing government administration and the regulatory environment. Policies are changing. We have a new president, and President Trump has issued several executive orders that are signaling a dramatic shift in U.S. energy policy. The focus is on expanding fossil fuel production and rolling back environmental regulations. This is a dramatic shift. The Biden administration was much different. They were really rather unfriendly to the energy sector. They were really forcing what I would call the green energy. I would actually say they kind of had it out for the fossil fuel companies, the oil and gas companies. Um, this is very different. This is a sudden shift. No matter where you are on this issue, this is a fact. Things are changing, and we're going to see a more favorable environment. Some key takeaways from recent executive orders. The president has established a National Energy Dominance Council. He wants the United States to be energy dominant. It's going to be chaired by the Secretary of the Interior, Doug Burgum, who knows business and he knows the oil and gas industry. And of course, vice chaired by our Secretary of Energy, who's from Liberty Oil. His name's Chris Wright. You got the right guys to do this. They know the business, they know the industry. They're going to give their very best advice to the president. They're going to advise on strategies to achieve energy dominance. They want to look at what are ways to improve the processes for the oil and gas companies around getting permits, doing production, generating energy, distributing, regulation, transportation across all forms of American energy. This is key. These guys are going to be looking at the entire value chain for all subsectors of the energy sector. They're going to recommend strategies for getting rid of red tape and enhancing private sector investment and innovation. So, making it more efficient and getting more investment dollars into the sector. They want to champion domestic energy production. The key part of this that I mentioned is energy dominance. And the president believes, and I believe rightly so, is that this is an effective component to a effective national economic and national security strategy for the country. And President Trump is really the driving force behind all this. And we've heard him say many times, drill, baby, drill. He wants to basically take the handcuffs off of the oil and gas companies. All right, next one. And driving it down to the cabinet level agency, the Department of Energy, the Secretary of Energy, Chris Wright, um, has issued a number of, um, I would say, action items in his first executive order that came out February 5th. The focus is on advancing energy addition, not subtraction. We saw a lot of subtraction in the last administration. They wanted to subtract fossil fuels, they wanted to add solar energy, wind energy, green energy. Those things are fine, but you cannot essentially have an economy as big and as complex as ours running on those. Those are alternative energy sources or renewable energies, but it's not enough. He wants to unleash American energy innovation. He wants to return to a regular order on liquid natural gas exports. We have a lot of liquid natural gas we can supply ourselves. We don't have to import anything like we have been doing the last couple of years. But we can export it and we can supply it to the rest of the world if we want. And really, we can make a lot of money. And these companies will make a lot of money, and as investors, will do very well. Hitting closer to home, he wants to promote affordability and consumer choice in home appliances. We heard some of the stories that the last administration wanted to ban gas stoves or gas grills. Those are very American things that just didn't go over well. He wants to encourage that. He wants to refill the strategic petroleum reserve. It is essentially empty, and the previous administration drained a lot of it to dampen the high gas prices, especially before the election. And that should only be used for national security reasons. You shouldn't be using it for political reasons, but that's what we saw. He wants to unleash nuclear power. Okay, that is a source of energy that's really been underutilized. I think people are a little bit squeamish from the nuclear power plant accidents and leaks from the 1970s. It can be very safe and very effective. We have to tap into that, and that's where one of his focus areas is. The power grid. We've heard about the vulnerability of our power grid, and that if a bad actor were to, explode like or detonate a nuclear device up in the upper atmosphere, it could wreak havoc and shut down our electrical power grid and leave us all without power. We wouldn't have any electricity or wouldn't be able to really survive. It would be devastating. He wants to strengthen that, make it more reliable, and make it more secure. And he wants to streamline the permitting process and to make sure that we're identifying undue burdens on the American energy performers, the companies that are drilling and that are producing oil and gas. So you really have a friendly administration. I wanted to take a little time on those two slides to talk about that because I think that the regulatory environment is a significant driver that's going to affect um, investing in these companies. So, what is the energy sector? Well, there's a handful, I would say, of categories. And I would say basically you have non renewable energy and renewable energy. And in non renewables, you got your oil and gas companies. You also have your coal producers. You have your nuclear energy companies. That's, you think of ExxonMobil, we think of Chevron, those companies. Those are the non-renewable energy companies. The renewable energies, there's solar and there's wind and there's hydroelectric power. There's geothermal. There's biomass. Those are what I would call alternative energy sources. They're not quite We're not quite there yet to rely 100% on these. We're not looking to exclude them. We want to include them, but we need to really bolster and be favorable to oil and gas or the non-renewables. And if you look at, you can also tilt this thing on its side and look at the different segments or the different value chain components, and these two kind of run hand in hand. There's upstream, there's midstream, and there's downstream, all segments of the industry. And upstream are primarily exploration and production. The midstream segments are storage and transportation. There's companies that make pipelines and they actually transport oil and gas, or they may be driving trucks from position A to position B. Whereas the upstream are more the drilling and the producing of the oil. Then you have downstream. It's really the refining and the marketing. So those are really the segments, and then you can see those actually go right into the value chain components. What's not covered here, are the distribution. Okay, like the gas stations. We all know those. We all have to drive our cars and fill them up with gas, or power generation, like the electric company or the utilities. Those are other segments and subsegments, I would call, of the energy sector. All very important. We all rely on them very much. What are some examples? Well, I've listed a few here, so you can kind of get that classification etched into your mind, because this will make you more informed when you're investing in stock. I would say for the oil and gas companies, you have um, I'm going to go through four subsectors here. I would say integrated oil and gas, those are the big boys: Exxon Mobil, Chevron, BP, formerly known as British Petroleum, Shell, and Total Energies. And then, of course, you have exploration and production. ConocoPhillips, I'm a big fan. And full disclosure, I have a lot of stock in Chevron. I have some in Shell, some in British Petroleum, and a little bit, um, actually all of the integrated oil and gas, but mostly Chevron and less in these others. I also have stock in Sunoco. I like Sunoco. I use it a lot. Then exploration and production. ConocoPhillips. I love ConocoPhillips. I'm a big fan. What I love about them is that they pay a growing dividend every year, but they also pay special dividends. So I will get a quarterly dividend 4 times a year, but I'm also going to get a special dividend between 3 and 4. So I will get 7 to 8 dividends per year just off my ConocoPhillips holdings, and I love that. Marathon Petroleum, that is a good one. Not to be confused with Marathon Oil, which was recently acquired by ConocoPhillips. That was MRO. It's no longer its own company. The part of Conoco. Marathon Petroleum is different. Devon Energy and Hess Corporation, which is being acquired by, I want to say, Chevron. And then, of course, you have refining and marketing: Valero Energy, Phillips 66, and PBF Energy. And then you have your midstream companies: Kinder Morgan, Enbridge, ET Energy Transfer, and Energy Product Partners. I have stock in uh, Energy Transfer and Energy Product Partners. I also have stock in Phillips 66. All right, let's keep going. All right, we're going through and we're giving more examples of some of these companies in the subsector. Here's some examples of the utility companies. So there's NextEra Energy, or NEE. It's the largest utility company in America. Duke Energy is like in the top 2 or 3. Southern Company is another one. American Electric Power, Exelon, Edison International. That's actually not to be confused with Con Edison, which is New York. And Con Edison is actually not just electric, it's multi utility. Edison International is headquartered in California. Con Edison is headquartered in New York. Entergy and Dominion Power. I am a Virginia resident, so I am a investor in Dominion Power as well as Next Era Energy. The renewable energies, I tell you, I am still learning about these. I don't have really a lot of holdings in this group. but I did a little research and I have some examples of Vesta Wind Systems, First Solar, Orsted, Brookfield Renewables, Siemens, GameStop, SunPower, Solar Edge, Enphase. So these are primarily wind and solar companies. And as I mentioned, we're still, working to get these things to be more reliable and to generate more powerful. Well, right now they're kind of expensive and they just don't generate enough power. But we have people that are working to make them more affordable and reliable. Energy technology and services. Um, let me actually, I'm not going to go down the list from top to bottom. I'm going to take care of the ones that I'm really familiar with. Tesla, and they have a division there that is focused solely on energy, and they make batteries. So if you own Tesla stock, you're actually buying more than a car company. You're buying uh, a lot of things. You're buying an energy company. You're buying an artificial intelligence company, a data analytics company. You're buying a lot of things. Tesla, so they are in the energy game. General Electric, Vernova, GEV, split off from main General Electric, and that is actually rated very highly as a company to invest in. Seeking Alpha, I believe, rates it as a strong buy. So you might want to take a look at that. There's a handful of emergency energy startups. None of these have ticker symbols because they are startups. I actually looked it up, but I won't read them, but you can look at them. And I have these here really for a couple reasons. For you to get a good framework of understanding of how the industry is broken up. But you can go ahead and research these if you're interested. Okay, so why am I'm very up on the integrated oil and gas, and it's really two reasons. It's the three reasons. We have a great supply of liquid natural gas and oil in our country. We have a favorable, friendly government administration that is going to make the regulatory environment great for these companies, and it's great for us as investors. But also, number three is the PE ratios are near historical lows. They are edging up, but they're great buys. So if you look at what the PEs are for several of the leading companies compared to what they were in 2015, 10 years ago, ExxonMobil is now 14.05 versus 20 and a quarter. That's a significant decrease. That means they are have a nice upside if you're looking at history. And what I do is we look at what the historical trends are of the price earnings ratio. We also like to look at how they compare to their sector, but also to the larger market. And you can see at the bottom, the current PE ratio for the S&P 500 is over 30. So ExxonMobil is less than half of that. Chevron 15.92, much less than it was 10 years ago when it was 36 and a half. Total Energies 9, uh, less than half of what it was 10 years ago. Shell, wow, look at that, 13.33 versus 74. That is a strange PE ratio, and it probably bears a little bit of looking into. I have a little bit of holdings in Shell. I'm mostly in Chevron and ExxonMobil. Um, you can see, however, excuse me, um, that the PE ratios are inching up. Then they did come way down in 2020, but they are coming up. So you can see ExxonMobil 14 versus 11, Chevron a little under 16 versus a little under 10, Total Energies a little more than 9 versus 8. Um, Shell quite a bit more, 13.33 versus 4.88. Shell's kind of excuse me, Shell's all over the place. But the point is that these are cheap compared to the wider market and to what they were 10 years ago. And that's something you really want to keep in mind. And I wouldn't restrict anything that you buy to these. Do some research and take a look at these metrics. I think they're very important. And then here are 12 that I have found that I like. And I'm giving you the the current price, the consensus price target from analysts on Wall Street, and what the upside is. I'm also providing what the dividend yield is, the dividend growth rate, and this is a forward dividend yield. It's a 5-year average dividend growth rate and the dividend growth streak. Exxon is an aristocrat. They have an 18.8% upside. Okay. I'm not going to read all these. You can look at these, but the current price is 110. The target's 128. That's an 18.8% upside, which is nice. There's plenty of room for it to grow. Um, Dividend yield, 3.5%. That's a healthy amount. The dividend growth rate, it's a little bit on the low end, but it's 2.2%, but they continuously grow it. They've got it for 26 consecutive years. I like Chevron. They got an upside of 11%. They got a higher dividend yield. The dividend growth rate is over 6. They've been doing this for 37 consecutive years. Shell, only 2 consecutive years. I like the yield. I like the growth rate. They got an 18.7% upside. Coterra, a little bit smaller, also at 18.7% upside. The yield is small. It's not bad. It's a little under 3, but they got a really nice dividend growth rate of 19%. ConocoPhillips, it's one of my favorites. They have a huge upside. They're tremendously undervalued, 36%. A nice healthy yield of 3.5%. The growth rate of more than 16%, and they've been doing it for 8 consecutive years. Devon is another one. I'm gonna kind of go through them quickly. Energy Transfer, I do like this one, and I'll tell you why I like it. It is cheap, dollar wise, and one of the things that I talked about in my last video is that I've started trading options and selling covered call uh, options, and this is one of them. And to do that, you better have 100 shares. So I got a few hundred shares of Energy Transfer, and I've been selling some covered calls, and I'm kind of dipping my toe in it. And I want to give a plug to a colleague of mine, Dividend Stockpile. Um, Take a look at his videos. He does a lot of options trading, and he does a really good job of explaining it. He makes it come alive. Anyway, Valero is another one, a little under 15% upside. Kinder Morgan, 10%. These all have upsides of more than 10%, but I'm also providing the dividend yield and the dividend growth rate. So you can see you're going to get price appreciation, very likely, but you're also going to get a nice, healthy, growing dividend. And we like to look for a nice dividend streak. We also like to see a nice dividend growth rate. In these 12, they have that. Is this all of them? No, but these are the ones that I am comfortable with. And I'm not saying, hey, buy these. I'm just saying this is what I am doing, and this is what I have done. All right, those are the 12. And folks, that's it. One thing I want to say is that, and I've mentioned in other videos, is that I am an affiliate partner of Seeking Alpha. And if you are interested in subscribing to Seeking Alpha, I can get you a $30 discount. I am a subscriber, and I do not do any of my analysis without having my Seeking Alpha subscription open. I refer to it, and I love the research and I love the analysis that goes into it. The affiliate referral link is at the bottom and at the top. So all you got to do is just copy and paste it or type it into your browser, and you'll get $30 off an annual subscription of the Seeking Alpha Premium and a 7-day free trial. I don't think it gets better than that. All right. Um, if you follow me on social media, you'll see me on X, you'll see me on Instagram, you'll see me on Facebook. I share lots of different content across all 3 platforms. I also have a few colleagues that I would mention. Dividend Snowball, he's on X and he's on Facebook. Wonderful discussion groups with really smart people to talk about dividend investing. They focus a lot on ETFs, but also on stocks. I'd recommend giving them a look. Good stuff. A couple other colleagues, Quality Dividend Investing and Growth, Saving and Investing for Beginners, and Dividends Are Us. Give them a look. All good folks. A lot of good content there. And that is it. I hope you found this to be enjoyable. If you would, give us a thumbs up, share the video with a friend, hit that notification bell, and subscribe to our channel. And until our next video, have a wonderful day. God bless.